Today, President Joe Biden cut short his visit to the Asia Pacific and specifically his planned trip to Australia, where he is due to address our federal parliament. He's returned to Washington to preside over the looming debt crisis in America as the Democrats seek a political solution to raise the nation's debt ceiling from its current $31.4 trillion. Now, by coincidence, our own Stephanie Nash is in New York and caught up with the WAM Global Funds investment manager, Catriona outside the New York Stock Exchange.
We have seen this issue come up before. I think we will get there and get a resolution by that June 1st deadline because really it isn't in either party's interests for the debt ceiling increase to not occur. You've got 66 million Americans on Social Security that need those benefits paid. You've got federal workers, you've got military needing payments. So I think we will get there. Perhaps there'll be delays. It really isn't in anyone's interest for that debt ceiling not to be raised. So.
If there was a default, what would the market impact likely be?
Oh, look, I think there would be a hit to the market because the reality is that if those people aren't getting paid, that has a significant consumption impact. So, I think there would be impacts for both, whether it's the consumer companies, for the economy at large in terms of economic growth. So I think for all the reasons, of the consequence, I think we'll get there.
What did you make of the current US earnings season? What were your key takeaways?
Well, it has been a mixed earnings season. I think, if you look at the effect of rising interest rates, last year as rates were going up, we certainly thought, okay, where are the sectors that are going to be impacted by rising rates, and tried to position away from those companies. And even today you've seen Home Depot report, and having previously thought that earnings would be flat, they're now saying earnings will be down by 5%. So that's a very interest rate affected sector. You are seeing consumer goods companies struggle. Even CPG companies, it's certain consumer product goods companies are suffering slight decreases in demand as interest rates have gone up. But on the other hand, you've got companies in the healthcare sector, for example, that are actually doing very well. There's a business, HCA Healthcare, that we own, which is the largest private hospitals operator, and they actually increased guidance because some of those pressures that they had last year, such as nursing shortages, are alleviating. So I think it's a mixed picture, but at the margin, those interest rate rises are affecting demand.
A lot of economists are saying it's likely that the US is already in a recession. How do you think US companies are going to hold up?
I think there'll be winners and losers through any crisis or recession. You tend to see the better companies, the better the companies with the better management teams deliver and actually use downturns and recessions to come out the other side with higher market shares, etc. But I think at the margin, if you aren't operating your business well, it has been a tough operating environment already through the pandemic supply chain, and then if you then get hit with a consumption hit through a recession, there will be businesses that do suffer. But so I think it'll be a real time for winners and losers to come to the fore, and it's a time to find those businesses, those quality businesses that can actually continue to grow earnings and can actually come out the other side better positioned.
Catriona, what's your view on the banking crisis? Do you think that there might be, more run of the banks, for example, off the back of SVB?
Look, I think there certainly could be other bank failures. It's been an interesting backdrop for the entire banking system, in that you've had this period of incredibly low interest rates. You've then had interest rates rise at an unprecedented level, and you've got this asset liability mismatch issue right now, where uninsured deposits are being taken out of certain banks, and then you've got assets, in the form of held to maturity mortgage liabilities, etc., that are getting revalued. So it is causing issues for certain banks, and I think there is potential that additional banks do fail. But I think the system as a whole, is in relatively good shape. And that analogy of you see who's swimming naked when the tide goes out it does come to bring to the fore those banks that haven't necessarily had the best risk management, etc., through this period of incredibly low rates. So our expectation isn't mass fallout in terms of the financial system, but you could certainly have additional banks go under.
And what about the tech sector with its recent, string of layoffs and write-downs? Do you see that mellowing out in the future?
I think, again, there's been, certain businesses that have taken advantage of low rates that actually didn't have business models that really stand up through the test of time. And so I think the unwind in the tech sector is actually quite healthy in general. We do expect, in terms of those layoffs, that when you look at actually the layoffs in the context of a lot of the amount of pandemic hiring that was done, it is quite marginal. And what you have seen is actually, even in the actual, when you look at other businesses across the economy, there's no doubt that the pandemic has shown that we all need to implement better technology, whether it's the cloud, etc. And I think what you've seen is that the period of layoffs and that unwind of some of those loss-making tech companies is actually quite healthy for the system. And so yes, we do expect that there could potentially be additional layoffs because the economy is slowing, but I think it's actually quite healthy for the system, and that you'll see that the best tech companies and those businesses that actually have sustainable business models will come out the other side in actually good shape.